Here's something nobody talks about. New York has more billionaires. Shanghai moves more manufacturing capital. Dubai has more ambition per square foot than almost anywhere on the planet. And yet, every single morning, before Wall Street even opens, the world's most powerful financial machine is already running. It's been running, actually, for over 300 years. London. Not because it's the richest city, not because it's the biggest, but because it figured out something that every other financial center is still trying to copy, and failing. And the uncomfortable part? The reason London works has almost nothing to do with money. Let's start with a number. Every single day, the London foreign exchange market processes roughly $2.7 trillion in transactions. That's not a year. That's not a quarter. That's a day. To put that in perspective, that's more than the entire GDP of France, changing hands in 24 hours in one city, while most of its citizens are buying overpriced coffee and complaining about the tube. London controls about 38% of global foreign exchange trading. The next closest? New York at around 19%. That's not a competition. That's a dynasty. But here's the question nobody asks. Why London? Why not Amsterdam, which had the first modern stock exchange? Why not Paris, which had the resources? Why not New York, which has the sheer gravitational pull of American capital? The answer goes back much further than most people expect, and it involves a very convenient accident of geography, a very deliberate accident of law, and one of the most quietly brilliant financial maneuvers in modern history. Let's go back to the 1600s. Britain is building an empire, and empires are expensive. You need to finance ships, wars, colonies, trade routes. All of it costs money that governments don't have sitting around. So Britain does something radical. It builds a system for borrowing at scale. The Bank of England is founded in 1694, not as a central bank in the modern sense, but essentially as a machine to fund the government's debt while keeping creditors confident. It works. Britain's borrowing costs drop. Its rivals don't. Suddenly, Britain can afford to wage longer wars, build bigger navies, and expand further than its competitors. Finance becomes a strategic weapon, and London becomes the place where that weapon is forged. Fast forward 200 years. The British Empire is at its peak. London is the clearinghouse for the entire global economy. Cotton from India, rubber from Malaya, gold from South Africa, all of it gets priced, traded, and financed through the City of London. Not because Britain is producing all of it, because Britain controls the system that values it. That distinction matters enormously. Then the 20th century happens. 2 world wars. The collapse of the empire, the rise of America. By the 1950s, it genuinely looks like London's run is over. The dollar replaces the pound as the world's reserve currency. New York takes center stage. And here's where the story gets interesting. In the late 1950s, something strange starts happening in London's banking sector. American dollars, held outside the United States, start flowing through London's banks. These are called Eurodollars, and they exist in a kind of legal no-man's land. The U.S. Federal Reserve doesn't regulate them. Britain's own banking rules don't fully apply to them either. London, essentially by accident, becomes the offshore home for a parallel global dollar market. And the City of London does what it has always done throughout history. It doesn't fight the new reality. It services it. British banks, American banks, Swiss banks, Japanese banks, they all set up in London specifically because London lets them operate in ways their home countries won't. It's not a loophole. It's a design philosophy. This is the thing people miss about London. It's not just a marketplace. It's a platform, neutral, permissive, deeply experienced, and obsessively good at one thing, making deals between parties who don't fully trust each other feel safe enough to happen. That's what 300 years of doing this buys you. Not just infrastructure, trust, legitimacy. The assumption, baked into global finance, that if it clears through London, it's real. Now, every few years, someone declares London finished. Brexit was supposed to kill it. Thousands of jobs would move to Frankfurt. Dublin, Paris. The financial apocalypse was coming. Some jobs did move, but the City of London's foreign exchange dominance actually increased slightly in the years after Brexit, not because Brexit was good, but because the network effects of being London, the lawyers, the accountants, the time zone, the language, the case law, don't pack up and move to Frankfurt because of a referendum. Frankfurt is a fine city, but it doesn't have 200 years of maritime insurance law. It doesn't have Lloyd's of London. It doesn't sit in a time zone that lets you trade Tokyo in the morning and New York in the afternoon with the same team. Geography, it turns out, is not just mountains and coastlines. It's also relationships, legal frameworks, and institutional memory. What London actually represents is the durability of first-mover advantage when it compounds over centuries instead of years. Silicon Valley got a 30-year head start in tech, and it's still dominant. London got a 300-year head start in finance. The moat isn't the Thames. The moat is everything built around it. The norms, the networks, the quiet assumption that this is just where these things happen. That's both London's greatest strength and its most fragile quality. Because systems built on trust and habit are powerful right up until the moment the habit breaks. Cities like Singapore, Dubai, and Shanghai are not trying to beat London by being better at what London does. They're trying to build entirely new financial architectures, digital assets, sovereign wealth corridors, state-backed financial ecosystems that don't need the old rails at all. So here's the question worth sitting with. London didn't become the financial capital of the world because it deserved to. It became the capital because it was early, it was adaptable, and it understood that the real product was never money. The real product was the confidence to move money across borders between strangers. It's held that position for 3 centuries, through the death of its empire, through 2 world wars, through the rise of the dollar, and through its own political self-sabotage. But the history of finance is also the history of systems that looked permanent right up until they weren't. So the real question isn't whether London is still the financial capital of the world. The question is, what would actually have to happen for it not to be?